which is all fine and dandy. And I'm all for using leverage in a very ingenuous way, but you have to be careful of those moments, those liquidity moments. Or
welcome back, everyone, to the Passive Road to Retirement podcast. Today, we are joined by Nikolai Ray, who is the CEO of MREX. Nikolai is a founder and CEO of MREX, as well as a professor in real estate financial engineering. He's regarded as one of North America's leading experts in apartment investing, with over $10 billion in analysis, underwriting, and transactions. Nikolai, thanks so much for coming on the show, and glad to have you here.
Hey, thanks, Andrew, for having me. It's a pleasure.
No problem. So, Nikolai, you've got a lot going on right now, multifamily world. What are you most excited about right now? And on the other side, what keeps you up at night?
That's a great question. What I'm most excited about is just the fact that we're living through very, very unique times, both financially and socially. And for someone who's as curious as myself, intellectually, and it's very exciting, And it's funny because that's the exact same answer to your second question. What's keeping me up at night is exactly the same thing, right?
Right.
Because we're living in such unstable and different times. That's definitely, I wouldn't say it keeps me up at night, but that's definitely something you have to be very cognizant about because, my specialty is in financial engineering and real estate. So, and financial engineering is essentially an umbrella of two things under it. One thing is maximizing returns, essentially generating what we call alpha. But on the same token, on the other side of the token is risk management, right? And thinking and being cognizant of beta, which is more of a risk, essentially a risk metric. So that's kind of the way that I'm looking at the multifamily real estate market. I think there's a lot of money to be made, a lot of great projects, a lot of great returns, but obviously there's a lot of risk involved in what we're doing. There's probably a lot more risk in multifamily real estate right now than there ever has been, or at least has been in the last 20, 25, 30 years. So that's something that's kind of new because multifamily has always been a very, and not to say that it still isn't, but multifamily, I mean, obviously has always been a very stable asset, right? The interesting thing about multifamily and apartment buildings is that you are generating returns, thanks in part to leverage, that are not that far off from the stock market, but with a lot less volatility and hence a lot less risk, right?
Sure.
Right now, with cap rates being so compressed, interest rates being so compressed, and everyone jumping into multifamily, I think because of what happened in 2008 after quantitative easing and also the Jobs Act in 2012, the risk spectrum is probably higher than it's ever been in multifamily, but that doesn't necessarily mean it's riskier to invest in multifamily. So that'd be my way of answering that question. And I know that's a long-winded answer, but it's probably the best way of looking at it at the moment.
No, that's a great answer. Now, as far as risk with the pandemic and everything going on, what would you suggest for somebody? How can they hedge themselves against risk, I guess, with multifamily? Do you have any tips that somebody could?
Well, I think the best way to mitigate risk in multifamily, the two major things that really are at the core of risk as a multifamily real estate investor. This is something both as an active investor or even as a passive investor that one should be conscious of is liquidity risk on an operational basis, right? So cash flow.
Yep.
So the biggest risk there is that you're not able to service your expenses and your debts because either you have too many debts, like you've used too much leverage, or you're having vacancy or occupancy problems, right? Or those the occupancy might be great, but there's too much loss to lease because people have lost their jobs or whatnot.
Right.
So you have to be very careful on because when you buy an apartment building, everyone's doing all essentially you're using pro forma analysis. You're underwriting the property, using various averages and rules of thumb. And a property might be cash flow positive pro forma, but that can go to hell pretty quickly, in the real world. So you have to make sure that you have enough money in the bank or, somewhere where if you're having trouble collecting rents, well, you don't end up with essentially a cash flow problem.
Mm-hmm.
The second major thing to be cognizant about is liquidity events. So what are the liquidity events? Essentially refinances or dispositions, sales, right?
Right.
So if you're banking on garnishing your bank accounts through refis or through selling properties, what happens if that refi happens when there's an expansion of the interest rates, right?
Mm-hmm.
Which is a possible thing. I'm not saying that's what's going to happen, but at the moment right now, as we're taping this, inflation is omnipresent, and like we haven't seen in probably 20 years.
Yeah.
Now, theoretically, all things being equal, if there's rising inflation, technically interest rates should rise, right? Obviously, economics are not as bidirectional or bilateral as that. They're much more complex than that. But you still have to think about that and keep that in mind. So, what happens if interest rates jump by 200 basis points, essentially 2%? What does your situation look like now, 2 years from now, if you had banked on a refi to buy out your LPs, or to pay back the seller financing that you got, or to pay back the credit line that you used maybe to use to build a part of your down payment? Like, there are various different creative things that investors are doing, which is all fine and dandy, and I'm all for using leverage in a very ingenuous way, but you have to be careful of those moments, those liquidity moments. Or if you were banking on selling at a 5% cap rate, and now cap rates are at 5.50%, what kind of situation does that put you in? Those are the real risks that everyone should be thinking of, and that's why when I teach financial engineering and real estate, what I teach people is to go much further than just what everyone else teaches, which is just basic underwriting upon acquisition, or what we call, essentially ex ante underwriting before you buy a property. You should be doing a lot of ex post underwriting, which means you should be underwriting once you've bought that property. You should update your underwriting models at least once to twice a year, ideally every quarter. And that way, that allows you to become much more precise in your underwriting. And that's what everyone should strive to, is precision. Everyone kind of hides behind the conservatism. I think conservatism is a second level of underwriting. It's a branch of being precise. I think a lot of people don't understand that, because a lot of people haven't put enough time and effort into their education in the multifamily investment world. And the fact of the matter is that most educators in the multifamily world don't have that education anyway. They don't have that knowledge base.
True.
And that's kind of what we've done with the MREX College, is trying to fill the gap in the knowledge base in the multifamily world.
That's a great point, especially, to underwrite once or twice a year after you've closed on the property. I don't know how many syndicators are actually doing that. So that is
maybe five, out of the billions of syndicators that exist right now. Because, I mean, let's face it, everyone and their grandmother is a syndicator now, right?
Yeah.
So, there are maybe 5%, the real professional, well-structured syndicators who don't even consider themselves syndicators are doing that, right?
Yeah. They're not the buzzword syndicator.
Right. Yeah, exactly.
Now with MREX, what kind of courses do you offer to teach people about that?
Yeah, well, I mean, MREX is essentially two distinct companies. So there's MREX and the MREX College. MREX itself is a technology company. People, if anyone wants to know about it, you can go on app.mrex.co. So app.mrex.co. Essentially, what we're building is kind of a centralized hub on an app for multifamily investors to access deals, to access the market intelligence, data, track your portfolio, track your own investments and stuff like that. A whole news cycle as well based on multifamily investing.
No, that's
At the
awesome.
MREX College, what we've done is essentially built an educational platform that is filling the gap between universities and coaches, mentors, and gurus, right?
Mhm.
Because in the investment world in multifamily, if you want to get educated, there's two ways. You go to college, you do a degree in finance or in real estate or whatever, but that's very institutional. That's
Mhm.
very kind of macro. It's not specific to multifamily.
Right.
It's much more focused on trading professional analysts, right? Or appraisers or people like that, bankers. On the other side of the spectrum, you have all these coaches and coaching seminars and organizations, and there's a lot of great ones. Like, my buddies Jake and Gino, who run a great one.
Mhm.
Rod Khleif runs a great one.
Yep.
There are many others. Brad Sumrock, Michael Blanc. There are a whole bunch of great guys out there doing that. But that's coaching, right? That's mentorship. That's focus a lot on give you the basics, the overall education, but really getting you into action, getting you to become a practitioner and an active investor, partnering on deals, building your network. So what we're doing is we've kind of positioned ourselves in the middle there where we want to help what all these coaching and mentorship organizations are doing. We don't see ourselves as a competitor to them at all. I think we're complementary to what they're doing.
Yeah.
But what we're doing is we're bringing that university kind of approach, college approach, really deep knowledge base to try and fill that gap where, as an investor, if you want to start buying apartment buildings, whether you're an active investor or a passive investor, you're not going to go back to college to do that. Like that
Right.
doesn't make any sense whatsoever.
Mhm.
And you might have actually gone to college and have a degree in real estate, but that hasn't taught you real estate, right? That's taught you institutional real estate, professional real estate. That's not real estate investing. So that's kind of what we're doing. Our most popular course is it's actually a certificate program. It's called the Certificate in Multifamily Real Estate Financial Engineering. It's essentially a 3-month program split into 4 sections where we teach everything from the finance of real estate, joint ventures and syndications. We teach financing from banks and institutions, Fannie, Freddie, to secondary financing like seller financing, and then corporate financing structures. How to use shares and various things to generate different stacks of capital. And then essentially we go to risk management and portfolio management at the end. So that's accessible to everyday real estate investors, whether you're active, passive, whether you're a syndicator, whether you're into joint ventures, whether you're just buying your own deals. You can. We've been teaching that in Canada for the last 5 years. We've had actually about 5,000 people come through our school right now.
Really? Wow.
And we're just expanding that to the US right now. I'm translating everything. It's, because I've worked both in the US and Canada. We have teachers who are both worked in the US and Canada. So so that's kind of what we're doing right now with the MREX College. I hope to see a lot of your listeners sign up to our school eventually. And
Absolutely.
Yeah.
I would definitely recommend it, especially, if you're taking down these multifamily assets that are $10, $20 million, you need to have that knowledge.
Even if you're taking down an asset that's $500,000, like if you're buying your first 6-unit property or your second 6-unit property in Orlando or Tallahassee or Pensacola, because I know you're in Florida and I spent half of my year in Florida as well. Wherever you're buying that, like, let's face it, even if you're buying that alone, you're putting $100,000 to $150,000 of your hard-earned dollars into one property. Diversification, as Warren Buffett has said, is not important if you know what you're doing. True. If you're buying your first multifamily property or even your third or fourth, you don't really know what you're doing. Let's face it. Like, if we're really honest with each other, you probably don't really know what you're doing.
Yeah.
And if you're investing $150,000 down payment into a property, like, you should probably be putting 5 or 10 or 2 or 3 or 7 into getting educated to make sure that at least you're de-risking what you're doing.
Yeah, you don't want to be losing that kind of money. Absolutely not.
The best way to lose $100,000 in real estate is to cheap on $1,000 of education, or cheaping on $1,000 of having the right professionals around you. And the best way to not make or generate $100,000 in net worth or surplus equity is also by cheaping on that $1,000 or that $5,000. I always like to tell people, like, you don't want to spend 1,000 on a tax lawyer. You don't want to spend 2,000, and it's not spending, it's investing. Like, you don't want to invest in a lawyer or an accountant or, in a corporate structure or in your education. Like, what are you doing then investing $100,000 or $150,000 into a property or into a syndication? Like, you're doing it all wrong. You have to switch from a consumer mindset to an investor mindset. And that's not spending money on things, that's investing money in things to make sure that your investments generate better returns,
right,
and take on less risk.
Yep, absolutely. I totally agree. And that's actually a great segment here into my next question for you. Was you've done a lot of real estate deals, obviously. Everyone has had one usually that's gone wrong or something has happened. You could just kind of give us an overview of one that didn't go exactly as you planned and what you learned from that.
Plenty. And that kind of comes back to the question you asked about, like, that's why I like teaching risk management. Like, I'll give you an example. Well, I'll give you a very simple example. We purchased a 7-unit property 2 years ago. We thought it was going to cost about $425,000 to renovate it. We paid $420,000 for it. So that's a pretty heavy renovation, right? That's a big value add.
Yeah.
It ended up costing us, $625,000 in renovation. So that's $200,000 over. That's not because we screwed it up. That's just because, if you're doing value add on older apartment buildings, well, even on not that old apartment buildings, like the minute you open up an apartment building that was built before like the 2000s, they're going to be surprises, right? They're always going to be surprises.
Yep, exactly.
So, essentially, you have to make sure that, like, we're well capitalized. Like, we have money. We're not newbies. So, like, it wasn't the end of the world putting in another 200. But if you went into that deal thinking that you didn't have any more money to put in, well, what happens? Where do you get that 200 from? You could be in a really bad position, right?
Yeah. Especially
so that's why I'm all for leverage, and believe me, I love leverage. I'm in financial engineering. Our job is to think of crazy ways to leverage more.
Yeah. Yep.
But that could never be without the risk management on the other side of things, because leverage it's a Damocles sword, right? It's a two-edged sword. And you can't swing that sword if you're not aware of the dangers that come with it, right?
Yeah. Yep. It can cut you just as much as it helps you. Exactly.
Absolutely.
Now, what do you on that? What do you feel about these syndicators and whatever people just taking on 80%, 85% leverage now? Banks are up in their LTVs. Do you do that to get more returns, or are you like to go lower leverage?
I personally don't syndicate. Like, we've purchased about 40 properties in the last 18 months, 40 apartment buildings. We're just a joint venture structure where it's me and two buddies, right?
Okay.
So that's all our money into it. We have maybe 3 or 4 family and friends that have also jumped in into a deal here or there, but it's essentially our portfolio and our money. So I'm not syndicating. However, I mean, in the past, I worked with a lot of syndicators as expert counsel, in the way they structure their deals. I think, obviously, coming back to what I said earlier, I think a lot of syndicators right now are doing it wrong.
Yeah.
I think too many people are syndicating, and it's become kind of a dangerous world because, like I said, everyone and their grandmother's a syndicator now. So I think that's dangerous. Leverage is a great thing, but it's a dangerous thing, right? So I'm very weary of. I see a lot of syndications, promising, 10% cash on cash pref, and then 20, 25 IRR. And then you look at their structure, they're at 85% LTV, IO loans, interest only loans for 4 years.
Right.
Damn, that's wow, that's some scary stuff there. Like, if you're an LP, like that's scary. And I think that's where a lot of LPs and passive investors are. Just because you're a passive investor or an LP doesn't mean that you shouldn't be as educated as the GPs and active investors. You should be, in fact, in some cases, more educated. Because you're essentially, it has to make up for your passivity, right, as an investor. Right. So I'm not saying don't use leverage, but I'm very weary of the way that people are using it. Like, it seems like it's all upside and there's no risk management into it. That's why I'm so fond of teaching real estate financial engineering because I think the risk management is even more important. And I think the more you learn how to manage risk, the more you can generate alpha and generate really great returns.
Absolutely.
So, yeah.
Yeah. If you know both sides, you know what your loss could be or the upside, and you're much better prepared.
Right. There's a big problem in real estate. It's called, it's survivorship bias, right?
Mm-hmm.
No one sees anyone who screws up because they just disappear.
That's true.
So all we see is that people are succeeding. And we're not seeing, at the minute anyone loses any money, both as a syndicator or as a passive investor, they usually disappear and don't talk about it because they're so ashamed.
Yeah.
So I think you have to be very careful. And, let's face it, we haven't had any headwinds in the multifamily market for quite a while, at least since 09, 010, 010, at least since 09 and 2010. And even then, the headwinds weren't that strong. And they only lasted maybe 6 or 7 quarters. And they weren't that heavy, right? So we really haven't had any headwinds in the multifamily market since probably the mid 90s.
Yeah. Yeah, it's been very resilient versus single family,
Right.
with 2008.
Right. Versus single family, commercial real estate, office spaces, retail, stock market.
They're getting crushed right now. But Nikolai, what kind of habits do you have? People always ask, what somebody successful like yourself, what kind of habits you have or have developed over the years that help with your success?
I think continuously being a student is probably the biggest habit. Being a student, being very humble, and I know sometimes people think that I might be, a bit cocky and arrogant, but I mean, what can I say? When you've been a successful entrepreneur for 15 years,
right,
and you've done over $10 billion of real estate, you can't not talk about that without some people seeing that as arrogant or cocky.
Yeah.
When in reality, we were just stating the facts, right? And
right.
I think you have to have a strong self-esteem, and strong self-esteem is often misplaced as arrogance by people who don't have a strong self-esteem. But I consider myself very humble and have a lot of humility because I'm always questioning what I'm doing, and I'm always questioning what I know.
Yeah.
And I'm always trying to learn more because I know that there's so much still to learn. So that's probably the most important habits of being successful is, not falling into arrogance of what you think you know and how good you think you are.
Yeah.
Yeah. And not becoming complacent as well. I think that's probably the most important habit to success, both in business and real estate.
Yeah, I mean, especially with things changing all the time, loan structure is changing, and it's always something to keep up on. Go to conferences.
Absolutely, you can always learn something new, and sometimes it's just being open to challenging yourself. And I'm always open to sharing what I know because I want people to kind of challenge it, so I can challenge it myself and maybe build up even stronger ideas and stronger philosophies and better strategies. Right? Like you said, times change.
Yeah, exactly. Now, Nikolai, if you could look back to your 18-year-old self, what would you, tell that young man?
Don't be so damn impatient.
What's the rush?
Because a couple of days later, you're going to wake up, you're going to be almost 37 and realize, geez, if you were maybe a bit more patient at first, time goes by fast, and we make all these plans and. You read all these personal development books, and 5-year planning is long term. 5-year planning is tomorrow.
It goes like that.
Everyone should be focusing on 25-year planning and try to remember how 25 years is not that far from now. And recently I'm turning 37 soon. I was just thinking about the last 10 years. I'm like, damn,
flies by.
I thought I was on top of the world when I was 27. I was nothing compared to where I am now. And I try to keep that in mind. Think about where I'll be at 47. 47, I'll be such an old man, but it's not, it's tomorrow, right?
Exactly.
So I think trying to keep that kind of long-term mindset without getting complacent and lazy in the short term is
right.
There's the concept of the clouds and the dirt. I think that kind of, keeps it in mind where you want to be cognizant of the clouds and the long-term game and think about that. And long-term is not 5 or 10 years. It's 25, 40 years, right?
Right. Especially if you're going to be in real estate for that amount of time. I mean,
yeah, exactly.
Not that long. Yeah.
Yeah. I think a lot of mistakes are made by people trying to go too fast. Yeah.
Yeah. Yeah. And that's, like you said, that's where you make mistakes too. You go too fast, you don't have the education. It could be a problem.
For sure.
What would your number one takeaway be for our audience to absorb from this show, if you could pick one thing?
Never stop learning. Like,
Yeah.
the minute that you stop learning, you're dead. Like that's it. You're dead because either the market's going to surpass you, or because you're just too arrogant and you think that you know it all. Like, so that's just the beginning of the end for you. Essentially.
That's a great point, actually. Yeah.
And I mean, that doesn't mean, and I'm not one to push courses down people's throats, or I don't have to sell anything. Like, I'm 37. I'm 37 soon. I've been very successful for the last 15 years. I could chill by the lake here, but I live by a huge lake. I can just chill here for the rest of my life. I don't need to sell you anything. So I'm not talking necessarily about courses or mentorship or coaching programs. Just be learning, be a student. Like, always, that can just be thinking about what you're doing and questioning yourself and trying to redevelop what you're doing. It can be reading it. It can be searching other people who to discuss with and getting them to challenge what you're doing. And just being a constant student.
Always be curious. Exactly.
Yeah, for sure.
Are you reading anything right now that you'd like to share with the audience, that they should read as well?
Yeah, I go through phases where I'll just read probably 10 books a month. Then I'll go through phases where I won't read a book for 3 months. I just get tired of it. So, and when I'm in that phase, usually what I'll do is I'll always kind of pick books that I've already read and just kind of go through a page or two here and there.
Yeah, it's a good idea.
So I'm reading right now. Stop Doing That Shit.
Yeah.
And Tribe of Mentors. Yeah.
Oh, that's good. Yeah. Tribe of Mentors.
Yep. Tim Ferriss.
Yeah. Oh, Tim Ferriss.
It's an easy bathroom read. Every morning you go to the bathroom and you can just kind of read a couple pages for 5 or 10 minutes, and it's oh yeah, I forgot that. I stopped doing that, or just kind of get you back into the right mindset.
Yeah, that's a great point. So I got one more question for you, and then we'll get into our 5 to Thrive section of the show. If you could step into my shoes for the interview, what question would you ask yourself that I didn't ask you?
That's a really great question. Boy. Huh. One subject that I think is interesting is we're in this era now of social media where everyone is, everyone's following Gary Vee and other gurus. And I mean, I love Gary Vee, by the way, not to bash on him, but I think a lot of people have misunderstood a lot of what these guys are talking about, these guys and gals are talking about. And, I think too many people are not doing what they should be doing and trying to do what everyone else is doing, right? Everyone has a podcast, and this is funny because you have a podcast. We're talking right now. And I'm not necessarily pointing fingers at you, but I think a lot of people have podcasts, which is cool. That's awesome. A lot of people are syndicating. A lot of people have blogs. A lot of people are trying to build their followings, and I'm just not convinced that it's the right thing for everyone.
Yeah,
I see a lot of people doing it and not getting any traction whatsoever. I'm yeah, but you should probably be focusing on other things. So I think. Always question what you're doing and think about, is this really the best use of my time, my talents, and my personality? And I don't think a lot of people are conscious enough about that. That's funny because Gary Vaynerchuk is the first one to talk about generating, massive amounts of content, but he also talks about do you, right? And be conscious of who you are.
Right.
And we're not all Gary Vaynerchuks. And myself included, I'm definitely not Gary Vaynerchuk. Far from it. And I see a lot of people trying to be a Gary Vaynerchuk, and I think it's a mistake, and they're going in the wrong direction, and they're wasting their time and energy on something that's not, they're putting 80% of their time into something that's maybe generating 20%, 10% of results. And
the golden rule,
that's
right?
probably, yeah.
Yep.
So not really a question, just kind of something I'm thinking about.
Yeah. No, that's a great, I mean, just because someone else is doing it doesn't mean you need to do it.
Exactly. I think right now, a lot of people, especially in the real estate world, are feeling like they have to have a social media following. They have to have a podcast. They have to write a book. They have to say that they're an expert. You know what? Most of them are not experts. It gets laughable, and essentially undermines what you're trying to do.
Mm-hmm.
I see these people claiming they're experts now selling courses. I'm like, dude, seriously, you've been in real estate for 4 years. You're not a sorry for the bad language. You're not a fucking expert. You're a beginner. Like, you're a beginner, dude. Like that's just it. And there's nothing wrong with that.
Right.
Teach a course on what it's like to be a beginner. Don't teach a course as being an expert. You're not an expert. So I think that's kind of, and I think Gary Vaynerchuk says that a lot. Do you stop the fake until you make it is so 1980s and 90s.
Yeah.
Like it doesn't work anymore.
No.
People see through that shit. Don't do that.
I stay off of Facebook as much as I can, honestly.
Yeah.
So, by the way,
whatever resembles how you are. Like, I'm sure I could kill on TikTok, but I hate it.
Right.
So I'm not going on it. I just find it's a waste of time. And sure, I could probably get my message spread to much more people. I see real estate people with a lot less experience killing on TikTok. I just don't feel like doing it. I don't like it. So you know what? I won't do it.
Yeah, I agree with you. Like you said, be your own person. Don't follow the crowd. Exactly. By the way, your YouTube content is great. So
thanks.
Speaking of social media, the Realpreneur episodes have been.
I like YouTube more.
Yeah.
And when you like something, you just do better at it too.
That's true. So yeah, a lot of great content in there. The one I like was, "Are you scared of asking for money?" That was a really good video you had there. I've never seen one like that.
A lot more content coming. Wait till you see the next couple months of what I got planned for the YouTube channel on MREX College. Yeah,
we'll put that in the show notes too, so somebody can just click the link and go. So now we're into our 5 to Thrive here. So this is like a word association game. Basically, I just rapid fire five words to you, and you just tell me the first word or phrase that comes to your mind.
All right.
But the only thing is you can't repeat the answer twice.
Okay, perfect.
All right, here we go. First one is real estate.
Freedom.
Mm-hmm. Leverage.
Life.
Yeah. Growth.
I can't repeat. I was going to say life.
That's what gets tricky, right? Exactly.
Growth. Raison d'être. This is the French saying of, your why, essentially.
Oh, okay. Yep.
I think we're meant to advance in life, and if you're not growing, then you're dying. So,
and that's been a big point you've been saying is always learn, always grow.
Yep. Absolutely.
Success.
Responsibility.
That's a good answer. No one said that before.
Yeah. I think if you can be somewhat successful in life and you have, the competencies or the energy or the personality, it's your responsibility to yourself and to society to be successful.
Yeah. I like that answer a lot. That was a good one. MREX.
MREX. The NASDAQ, Robinhood, and Zillow of real estate investing.
I like it. Great. Well, Nikolai, thanks so much for coming on. It's been a pleasure having you here.
Appreciate it, Andrew. That was fun. Thanks a lot.
Same here. So we'll talk soon.
All right. Take care. Thanks a lot.